Hi, welcome back to my channel. In today's video, we're breaking down two powerful stock market formulas, earnings per share or EPS and the price to earnings ratio or PE ratio. We'll explain what these numbers mean, how to calculate them, and why investors use them to analyze stocks. By the end of this video, you have a much better understanding of how to use earnings per share and PE ratio to evaluate a company. Let's get started. First, let's start with earnings per share. Have you ever wondered how much profit a company makes for each share of stock? That's what exactly earnings per share tells us. Earnings per share measures how much profit a company makes for each share of stock. The formula is earnings per share equals net income minus dividends divided by average outstanding shares. Don't worry if the formula looks complicated. Let's break it down with a simple example. Imagine a technology company reports the following at the end of the year. Revenue, $25 million. Expenses, $18 million. Net income, $7 million. Preferred dividends, $1 million. Average outstanding shares, $2 million. Now let's calculate the earnings per share. Earnings per share equals $7 million minus $1 million divided by $2 million. Earnings per share equals $3. What does that mean? It means the company generated $3 of earnings for each share of stock during the year. So if you own one common share, that share represents $3 of the company's annual earnings. Why does earnings per share matter? Generally, a higher earnings per share can indicate that a company is generating more earnings per share, which can be a positive sign. For example, Company A earnings per share is $2. Company B earnings per share is $8. Based on earnings per share, Company B generates more earnings per share than Company A. But here's the important part. Don't judge a stock by earnings per share alone. Investors should also look at some factors such as revenue growth, debt, cash flow, profit margins, and the company's valuation. It's also important to compare earnings per share with similar companies in the same industry. Earnings per share is one of the important pieces of the puzzle, but it's not the entire picture. Second, let's move on to PE ratio, or price to earnings ratio. The PE ratio tells us how much investors are willing to pay today for every $1 of the company's annual earnings. Here's the formula. PE ratio equals stock price divided by earnings per share. Example, stock price is $100. Earnings per share is $5. Let's calculate PE ratio. PE ratio equals 100 divided by 5 equals 20. This means investors are paying 20 times the company's annual earnings for each share. High PE ratio between 30 and 50 or higher than 50, that means investors expect strong future growth. The stock may be expensive relative to current earnings. Low PE ratio between 5 and 15, that means the stock may be undervalued, or the market expects slower growth or high risk. There are two types of PE ratios. First, trailing PE ratios based on earnings from the last 12 months. Second, forward PE ratio based on expected earnings over the next 12 months. Remember this, it should be compared with number one, companies in the same industry. Number two, the company's own historical PE ratio. Number three, the overall market average. For example, if company A has a PE ratio of 15, company B has a PE ratio of 30. Company B's PE ratio is twice as high as company A. A higher PE ratio could mean investors expect faster future growth, have a greater confidence in the company, or believe the stock is more expensive relative to its current earnings. If you found this helpful, don't forget to like and subscribe for more simple investing and finance tips. Thanks for watching. I'll see you in the next video.